Awesome. Well, Michael, thank you so much for joining us this evening, this morning, today. Really appreciate you taking the time.
Excellent. Thank you for having me. Yeah, it's good to be here in your evening, my early morning. Sun's just come up here in Singapore, so it's great to join you.
Yeah, and so you're out in Singapore. How did you end up there? Just briefly.
Oh, no, that's a long story. I've been here 18 years now. I studied Southeast Asian economics, and now I work in the finance industry for more than 20 years out here. And this is like the center of Southeast Asian finance, so it's the place to be.
Okay, very cool. And so today we're going to be talking about financial literacy, financial independence, growing wealth. And you wrote a book, right? Happily Ever After?
Yeah, so I wrote that book actually 5 years ago. I wrote it very specifically for a target market of one. And this was fun when I was talking to my publishers. It's now just been published by Wiley. And they're like, well, who's the target market? And I was like, my daughter. And like, who else? So originally, no one else. I just wrote it for my daughter. And because I went through a similar thing. Before I worked in finance, I'd actually been a journalist, and I got into finance, and I got into finance really kind of by accident, and I had to get up to speed very, very fast. And like within like a month or two, I kind of realized actually I can do this, and I felt two emotions at the same time. One, I was like, this is actually quite simple, and it's like really important. And then one of those two things hit me together. I was kind of angry. How are we not being taught this really simple, really important stuff? I knew immediately it was life-changing for me. And I thought, could be life-changing for everyone. And yet I've not learned anything. Like literally, it was kind of 2 months in. It didn't take a very long time. And it's not because I'm super clever. It's actually just that this is really some simple stuff. I don't use anything particularly clever today. It's a lot of really simple stuff. So I went through that. And I was like in my mid to late 20s when I went through that. And now, like 5 years ago, I'm looking at my 17-year-old daughter. She's about to go off to college. And I realized she's not learned any of this stuff either. And she was an arty kid. She's writing plays, poems, and stuff like that. And she doesn't want to learn math. She doesn't want to learn finance. I'm looking, I think she knows none of this stuff. I thought she could get into her 30s and 40s without investments, without savings, with debt. She can make a lot of mistakes. I need to get this through to her. But she's going to head off to college. So I've got a year. Do I want every single weekend to be filled with a lecture from dad? Is that how we want to spend?
How fun and exciting.
Yeah, right? It's just such a bad idea. So I was like, okay, I'm just going to get up and I'm going to write her a book. And I was thinking, and then it just kind of evolved into a fairy tale for a lot of reasons. And one of the big ones is because what were fairy tales originally? Originally, fairy tales were how you warned your kids to do the right thing and not do the wrong thing. Before Disney got their hands on it, this was all about don't go into the woods. It was all that kind of stuff. And it was like, and that really evolved very quickly into like how to get out of the woods, right? And if in modern language, right? So it's like, this works. And so that kind of got me on a roll, and it was all about, okay, how do you get from that kid not knowing anything about numbers, finance, to, okay, and the FIRE movement was a bit of an inspiration for this. So financially independent, retire early. How could she be financially independent? How can I get her in one book from knowing nothing all the way through to, okay, she can actually get all the way through to retiring in one book? And that was the goal. And so I think I've done that. There's not a huge amount of specifics. I don't get into the weeds on like how to do derivative trading, but I don't think she should. But that's where we kind of got to by the end of the book.
I'd love to know, I think probably in the process of writing the book, did it change at all of like the content of, or did you have a pretty well fleshed out idea in your head before pen to paper? I love the concept too of applying it as the fairy tale aspect of learning lessons, but I'd love to learn, if, did it evolve at all over the process of writing it? It
evolved a lot. In as much as I took a look at a first draft maybe about a year ago and I barely recognized it. But the structure was all there because, even before I did this with my daughter, maybe 5 years before that, I volunteered with a group here in Singapore that teaches migrant workers. There's a lot of migrant workers in Singapore. It's a small island. It's really developed, crazy expensive. So there's only maybe 5.5, 6 million people on the island, but maybe 1 million of them are migrant workers. And so they come from Bangladesh, Indonesia, Philippines, and really poor countries, and they're coming to make more money. But a lot of them are thinking also they'll save money, but no one's ever taught them how to do it. And so I saw a survey once that said that only 5% save as much as they intend to when they get home. So they don't change their lives. They kind of put their kids through school, but a lot of them spend 20 years here and don't even see their kids when they're young. And all of it kind of goes on spending, sending spending money home and all this stuff. So there's a number of groups that train them. And so I'd already developed a lot of the concepts, like at a very simple level, to how to explain how you move from not saving any money at all, how you start tracking. And within that, I built the basic chapter structure for my daughter's book. The basic chapter structure is using the word mission, which is explaining what 7 things mean, which is money, income, saving, spending, investing, owning, and doing it now. Because obviously that's the only time to invest, right? You don't invest tomorrow. And using that 7-chapter structure is still the same today, and it was right there at the very beginning. So if you've ever written a book, it's really important to kind of have that skeleton, and then you can write around it.
That's fantastic.
I love that acronym.
Yeah, it's good, right?
And it's just kind of like commentary. I feel like, those people, finance as an industry, love to like throw a bunch of acronyms and like do things kind of more confusingly. In this book, Happy Ever After, it kind of puts it right on its head. Instead of this confusing, more convoluted story, it's a fairy tale where it simplifies, not only explaining to your 17-year-old daughter, but kind of cross-cultural. So was this you talked about some of the migrant workers? I don't know, did some of that go in or distribution or
Yeah, so I worked with them for quite a few years, just sort of training on Saturdays. But while I was doing it, I was kind of seeing what they were already taught, retooling it, repurposing it, because I tell a little bit of a joke, and it's really not a very funny joke, so I shouldn't have introduced it as a joke. But finance is like 1% numeracy, 98% psychology, and 1% not worrying that it doesn't add up to start with. That's about right. It's really not very many numbers in it. There's not a lot of complex stuff in it. The reason we in finance use a lot of acronyms, it's not to confuse people outside. It's that there are a lot of layers on the things that we do, and we don't want to refer to all those layers every time we talk. CDO is a collateralized debt, debt obligation. It's like, okay, well, do you want to break that down every time we explain what we're doing here, what we're trading? That's by the way not what I do. But there are things beneath that, but we don't need to be at that level. When you're starting out, you need to know, I need to save before I spend any money. I need to once I've got enough savings as an emergency fund, I need to tuck that. I need to start putting it into investments. What do I need to invest in? Probably the biggest index fund I can find at the cheapest price. You get that right, you're at kind of 98% of perfection. Now, the next 2% take a lot of effort, but you know what? That's so much better than zero. And that's really where my book stops. At no point do I start getting into the weeds of saying, oh, you could do this better, you could do this better, you could do this better. What if I get a 1% higher return? That's the stuff that puts people off. And my goal is not to put anyone off. It's to find them where they're at and just kind of move them up one level. And then when you're up one level, because if you think about like a financial literacy as a pyramid, most people are at the bottom. It's a very shallow pyramid, not many people at the top. But if you look at the literature, most of it's up the top. It's all about hedge fund guys writing about how to invest in hedge funds. It's not about, okay, how do I go from knowing nothing to knowing one? And that's really where we focus, just that let's go from 0 to 1, first timer, right? And make them comfortable, because it's the psychology that really matters.
I think that's so interesting. I know here in the States, we talk so often complain about how the financial literacy is non-existent in schools. And I don't know if it's comforting or infuriating to hear that it's similar in the Southeast Asian culture as well, that it's just not taught in the schools.
Well, I think we're probably in the two parts of the world that have the best financial literacy. The US has the highest financial literacy rates on the planet, and the second highest are places like Singapore and China. But in reality, even here, proper financial literacy of so for me, I think that FIRE number, the 4% rule or 25 times your spending, is the perfect description of financial literacy. And the reason I say that is because that's the end goal. If you can actually explain, how do I never have to work again? How do I never have to worry about working for money again? that shows you've got real financial literacy because you've got an end goal and you kind of know how to get there. The goal tells you how to get there. So with that, I think there's like less than 1 or 2% financial literacy on the planet. And everyone wants to talk about, oh, but you should be doing this with your 401k or your Roth, or in the UK, it's your ISA or your junior ISA or your cash ISA, your stuff. It just overcomplicates things. Just get the money away, right? Get it away from you and get it to somewhere where it earns more than an interest rate in a bank. Like just even yesterday, someone replied to my Twitter. It's like, you can't make 7% interest rate. I was like, I'd never said interest rate. That said investment return. Why did you read interest rate? It's those are two totally. Why would you lend money to a bank? Why would you do that? It doesn't make any sense. It's like get an investment return. Totally different thing.
Yeah.
But people overcomplicate with these things, and that stops people from doing it. Just keep it simple, and people will come in, and then they'll learn. Right? That's the key. I'm sure with what you guys do is that people learn so much as they're doing it rather than before they do it.
Yes. There's the what's the saying? Well, there's the time in the market is so much better than trying to time the market.
Oh yeah.
Similar with real estate investing. You're going to learn so much more from just doing it than you could ever learn from a book or a lesson or a speech. What have you. So I've got to ask kind of the question that I feel like is being begged here. Where is your daughter today on her financial journey?
Oh,
how did the book land?
Oh, that's a brilliant question because she went off to college. So she read the book. She helped me edit the book. She worked on it. She told me she understood everything. And actually, also one of the key points with the way she edited the book and the way I worked on the book with even people after her was always, okay, be honest. Where did you stop reading? What got you so bored you couldn't push past that message?
Put it down.
Yeah, right. And so I got a lot of feedback, and it was the same page, and like, okay, got to take some numbers out of that and all that kind of stuff. So she got through the book, and she did, and she went off to college, and then she was in her final year at college last year when coronavirus hit, and she had to come home, and it was all kind of like everyone that age. It's a traumatic time to be at college. She came home, Singapore. She got a job 3 months ago, and she's put. I don't know what percentage, but she's put a percentage of every paycheck into an investment account every month since she got back. So for me, the book has worked. Like the initial target market of 100% success record, worth writing. That's done, right? But second customer, I don't know yet. But for her, it worked. It did its job. She's putting money away. She's not a finance geek. She doesn't pretend to understand anything. She just knows she's got to put money into an investment account so she was the person that came up with $7 Millionaire, my pseudonym, because we came up with it together. We were talking about compounding. We were talking about the number, whether it's the 4% rule or 25 times, and we were having that discussion. And she said, so if I think I need $1 million, right? So that would be $40,000 a year to live on. If I need that, what's the smallest amount I need to save every day to get to $1 million before I retire? Let's say at 70. And it's just one of those questions. I was like, Google it first, no answer. Then, obviously my second place is, okay, spreadsheet. 5 minutes later, she looks up, you still working on that? So yeah, I got it done. But I know it took me 5 minutes because I was double checking it and triple checking it because I was surprised it was just $7. And that's the thing of compounding. We kind of often take it for granted, but when you look at the compounding chart, you forget it kind of goes vertical so quickly, right?
It's exponential, yeah.
Yeah, it just goes vertical so quickly. It's like, how did $7 turn into? And I checked it and checked it and checked it again. Said it's only $7. And she's looked at me, you serious? It's like, yep, $7. You'll be a millionaire by the time you retire. And I think she's like lots of us think it's not in my realm of possibility to become a millionaire because we haven't thought about it. And when you have $7, like, okay, that's possible. And that just flicked a switch. I could see it in her eyes. And that's why I know when she came back, the money went away. She saved money at college. She actually put money away at college. She spent below her allowance and she put some money away at college, which, she was motivated from then.
Good for her.
She's not a money person. This is it's really all about okay, she understood it. She knows it's important. She puts it away.
So, and just digging a little deeper on that $7 figure. So what goes into that? So it's $7 a day at what percent
Yeah,
return
7%.
at 7% return for how many years?
Okay, so you start at 20, end at 70, right?
So for 50 years, $7 a day at 7%.
Yeah. So because she asked me, I mean, it's very specific. What's the smallest amount I need to save? And I was like, okay. But then
Smart
it has to
question.
be. Yeah. And it's like, well, what is the smallest amount? Has to be over the longest period of time, right? Essentially.
Sure.
And the longest period of time would be, okay, she's 17, she leaves college. And I'm not going to do it at 21 and a half. I'm not going to make my life hard with tough maths, right? Let's just do it over 50 years. So 50 years, it's at 7%. So it's not even, I didn't even do 7.2, which doubles. It's just 7% in the spreadsheet. And that turns it turns into $1 million at 69 and a half. You get like an extra, you get 200 days off, essentially, when you don't have to do it. But it's funny because you can kind of do it. I do it on my fingers now, right? So you do $7 is $2,555 a year, right? So it's $210 a month, $2,555. So that's 25 grand every decade, right? Now, if you start investing at the beginning, that 25 turns into 35 in the first decade. So, and then we're just going to do a quick proof, right? So 35 grand in the first decade. Now, because it's 7%, it doubles every 10 years. So you got 35 goes to 70, goes to 140, goes to 280, goes to 560. That's just the first 10 years of savings is 560 grand by the time you're 70. So you just do 10 years of saving at $7, and that's $500,000 by the time. Right, and then the other 40 years stack up the same way. So it's you can just do it in your head and on the math. It does actually back out, and it's such a small number. It's like you think about the average income in the US. Now, I'm not saying everyone can go for it immediately. It's very important to not say, look, everyone can do this, but a lot of people can. And the people who can't, who really, really can't, they can maybe start some of the habits that can lead them towards it. And that's the key. And even those people who can't can look at their kids and just say, you can do this because you don't work yet. You don't have all the costs yet. You haven't had this sort of lifestyle creep that we all get where we think, oh, I've earned this. I earn this. I have to spend this.
I deserve this.
Oh, don't. That one gets me. That one really gets me.
Kills me too.
Yeah, it's like the advertising campaign because you're worth it. I think I'm worth the money more than the cheesy advertising line. Yeah.
Yep. That's mind-blowing, Michael. $7 a day. I'm going to have to go do some restructuring of my life after this conversation.
That's beautiful. So the book has been released. Super excited. I'm looking at it on Amazon right now. How has the reception been? And kind of any ideas on follow-up, or do you think this is just like exactly the kind of piece that you need to put in now and it's good? Or I'd love to hear how kind of your relationship with the $7 Millionaire brand has evolved over time, and kind of thoughts on kind of next steps, or just push. Yeah, what are your thoughts?
Yeah, the reception's been very good. It's interesting. There's very rarely any pushback. I feel that everyone just says like, yeah, we need this information. It's kind of pointless us not having this information. I have more pushback in my own head from people than actually happens in real life, right? I'm so prepared for an argument and it just never comes. It's like people I think are on the side of this more than being against it. In many ways, that's insane, right? I mean, if we assume that there's not very many markets in the world where like everyone knows they need this. And no one is giving it to them. I mean, that's nuts, right? But that's what we're in financial literacy. So that's the reception's been strong. In terms of, my publisher have asked me to do another book. We had a conversation last week, and I'm like, no, probably not happening. I have full-time job.
You hit your target market.
Like, she's already doing what she's supposed to do.
Quit while you're ahead, while you're on top.
All right. So there are a couple of other concepts that aren't in the book that I would like to communicate, but honestly, they're not a book. This is a very unpopular opinion. I'm a bit critical of Malcolm Gladwell. I feel like he turns the tiniest idea into the longest book possible. And I always feel like when I've read a Malcolm Gladwell book, I kind of go, that should have been a magazine article.
That's a page.
I got that like 200 pages ago.
Why are we still talking about it? Yeah.
If I practice a lot, I get good at stuff. Okay. But I've got one other idea but it's literally the only other idea I have that I think is is missing from this book is actually how to invest. Is that the best way of doing it is once you've bought the index fund, use the index fund as your education. So, a lot of people think, oh, just index fund forever. And a lot of people find that dissatisfying. So they buy stocks before they buy an index fund because they kind of think they're cleverer than other people. So they buy stocks. And an index fund is the opportunity. It's a ready-made portfolio. You don't have to. Then what we do as portfolio managers, we run our portfolio and we look at it and we assess it and we work out what's worked, what didn't work, what was in the portfolio that worked and didn't work, what was outside the portfolio that worked that we didn't have and we could have had. And we use that as our starting point. Now, that's a really good exercise for like the next stage up from what I have in the book currently. I'm just not sure I could write a book about it, so I'm not sure I will. And I tend to do is sort of talk about it in blog posts and Twitter tweets instead, which I figure, same thing. People will get the information anyway.
People will read it, yeah.
What would you say? I think so. Like the opposite of apathy, like being really close to it. I know I sometimes like lay awake at night thinking like, man, why didn't I put a little money in Bitcoin? Like I knew about it in college. Like I knew about it back then. This sort of, I don't know, I guess second guessing yourself or, I don't know. What would you say to me who's laying awake at night thinking about Bitcoin, I guess on this kind of more speculative stuff that you don't know a whole ton about?
With all these, okay, we'll do two things, right? We'll go back to the people that want to buy stocks immediately, that want to be more speculative rather than so. The reason they want to do that is they've got this phrase in their head of, I want to beat the market, right? 90% of people who say they want to beat the market don't even know what the market is. Right?
Yeah.
Right? How is that number calculated? This thing that did 13.6% last year, how was that calculated? If you can't tell me how that's calculated, why would you want to try and beat it? How would you even know how to beat it if you don't know what it is? Right, so
you're sitting at the poker table, not knowing who's playing poker with you.
Yeah, right, and yet you want to beat them, right?
Every single one of them.
Yeah, it's like this is madness, and people don't know it's madness. So number one is that understand your own rationale why you're trying to do this. For things where but you asked a different question. You asked about say something like Bitcoin. You missed it.
Yeah, I don't know. GameStop. I don't know.
Yeah, anything.
I mean, that's a whole different bag of words.
But it's actually about learning properly. And it's fine to look backwards a little bit and actually think, okay, why did I make this mistake? So just within my day job, we missed an investment. We missed them at times. They're in your space and you get it wrong. And literally, I go see people at the company, people who've worked there, do my analysis, go back and say, why did I miss you? Why didn't I get your stock right? Why did I make that mistake? And I write it down. I write the report as to why I didn't do this correctly. And you have to make sure that you don't learn the wrong lesson. The wrong lesson is, Bitcoin's gone up, I need to jump into Bitcoin. It's like, why didn't I make this decision? What is there about this decision that I'm not making correctly? Do I need to do something else? Do I have a different mandate internally? This is actually getting very complicated, way, way, way away from the book. But it's all about learning. And so much of the learning is actually about psychology. It's like, do I like punting? Do I really love chasing those returns? Or do I need to understand that, I don't know what the market is, so I shouldn't be chasing it. I should actually, do I need to have a little bit of money into Bitcoin just so I can forget about it? Just like maybe put like 2% of my portfolio into Bitcoin and then, now I don't have to worry. If it goes up 100 times, yay. If it goes down, no big deal, right? And so it's about understanding what you need to take care of psychologically, rather than thinking any of us know about the future. None of us do.
I love it. It's a bit of a digression from the book, but I'm glad to have heard that. Yeah.
Yeah, we all do it.
That one's on the house.
Yeah.
Yeah, we all do it. None of us can predict the future, but it's so important to actually just know what is the mistake I made. Don't just assume you know the mistake. You know what the mistake was. Kind of go back and learn about yourself. This is why people like Charlie Munger and Warren Buffett are so interesting. It's not that they're so successful. It's because they show they're working. They're actually very, very open about their thought process. And these are really smart guys. But the smartest thing is about how open they are about their thought process.
That's so good. I'm curious, Michael, you mentioned a little bit ago about, some of the folks that maybe aren't able to put aside that $7 a day, but they can teach their kids great habits. What are some things, tips, tricks, tidbits, pieces of advice that you would recommend to folks who are just getting started and who really maybe want to make their first investment in real estate, but aren't able to get up to that point yet? They're just starting out with their financial journey. What are some things they should be thinking about doing?
Yeah. Okay. So in terms of the very, very starting points, it's about finding habits. It's really about working out the habit that you can develop that's going to have the biggest change. Because so much of this is habit, not actual, science or knowledge. There's habit. The most important one is so it's the order of mission, right? The acronym in the book. The first S is saving, the second S is spending. That's for a reason. It's like saving comes before spending. People who think, I have this conversation, and sometimes I've even said that 3 or 4 times, and people come back to me and say, so what I have left at the end of the month? No, that's money you accidentally didn't spend. That's not the same thing as saving. Saving is money you intentionally save at the beginning of the month. It's on the top of your budget. The stuff at the end of the month, nice. Put it into the savings account, but it's not savings. It's accidentally not spent. So if you can develop that habit of any amount of money, any amount, this goes away at the beginning of the month, and you put yourself on that you tighten that belt a little bit right at the beginning of the month by putting some money away. That is step number 1. Step number 2 is target that emergency fund. And that's the basic emergency fund. Some people talk about 3 months of savings, some talk about spending rather, some talk about 6 months of spending. I just think if you've got $1,000, you've got a base. You can start building up from there. $1,000. There was a statistic at the end of 2019 that said that I think it was 61% of Americans didn't have $1,000 of savings in their bank account for an emergency. And like the irony of that being at the end of 2019, whereas everyone had an emergency in 2020, $1,000, how far is that going to go? It goes $1,000 further than zero, right? It just avoids something, and it's a starting point. But if you get to 1,000, you can get to 2 because you know the path, right? And you can get to 3, and you can get to 4.
Do it again and again, yeah.
Yeah, exactly. And I think that's the first side. Then it comes a question of where you want to go next. My belief is everyone should be investing in growth assets. So whether it's, I tend to talk about equities and indices, but properties also, real estate, the other most important growth asset. But the thing I would say, okay, I am a private real estate investor. I think the thing I think is so important about real estate is to lose the 2 words, dream home. Too many people think that's the only kind of property you can buy. They have to fall in love with the thing, right? It's like, if you can afford a garage that rents out at 20%, do it. I mean, just buy that thing. Buy the property that gives you a good return. That's how property should be viewed. One day, if you can afford a dream home, by all means. But until you can afford it, it belongs in your dreams, not in reality. And that I would view that as if you want to invest in something physical, tangible, where you can collect a yield, then small, simple properties. I mean, particularly for people I think who have a skill set. Someone who can actually renovate stuff. I think it's one of the intriguing things about real estate. I don't know a huge amount about it, but one of the things I know is that big corporations don't do small real estate well. The little bite sizes are hard. So it's actually kind of a market which is inefficient, which people outside the industry always think that's a bad thing, but no, inefficient is a good thing, right? It means
it means opportunity.
It means opportunity, and it's so very often you can get very high yields, good returns as a small guy, which in the equity side and other investment sides, scale works, right? You get better returns on the scale. So that's one of the reasons why I think everyone should have a mix of those things. But emergency fund first, then into enough to get yourself either that deposit down payment on your first property. But have that low target for that first property. Treat it as an asset class rather than the dream home.
That makes so much sense.
This is so fantastic. So many of these episodes that we do end up being kind of self-serving. So, the way that you think about saving as, it's not just look at what's left over after the end of the month. It is at the beginning of the month, you move it. Mm-hmm. And then, if there's a little extra money after that, great. But you're not, it's that first initial savings is so important. I had never thought about that way, and I'm just writing some notes for my bank account that I'm going to be doing some changes and moving money across.
It's the first thing on your budget. If you put it as the first thing on your budget, right? It's like, it's not enough of us actually have a proper budget. And a proper budget, I mean, something that you didn't write in month one. Because a lot of us write, okay, I want to do this, and then we don't even track it. So we don't even know if we're close. But track it, know what you actually do. And like, I spent 25% of my money eating out, right? That all of a sudden, the next month when you budget, you can go, no, that's going to be 10 tops. Yeah. All of a sudden, you've just freed up 15% to save money, right? And you actually, when you know what you do, because you've tracked it and you've analyzed it and you budget it, then you found that, because if you do it at the beginning of the month, you have to find it from somewhere else, right? So you find it from the things you think you were overspending on. And this is the step that, the guy who talked about avocado toast 5 years ago, which was current when I wrote the book for my daughter. It's not so current anymore, but that guy, man, I think he pissed off enough people we can still talk about him 5 years later.
Easily.
And the people that wrote about lattes 5 years before that, it's like, it's not the latte, it's not the avocado toast. It is the thing you're spending money on that you don't want to, right? And you only know that if you track it. And so
you can't improve it if you can't measure it.
Yeah, but it won't happen accidentally. You won't just not buy. Let's have the opposite of an avocado toast, right? Let's say, I don't know, it's a meat pie or whatever it is, the thing that you spent money on that you didn't need to spend money on. You'll only know that if you only know you're doing that if you track it, and then you can plan it and you can take it out at the beginning of the month and put it into your savings. And now you know you're not allowed to do it, right? Because you're going to get short at the end of the month. But what it also does is there's a psychologically, again, I use that word all the time because that's what finance is. Personal finance is all psychology, 99% psychology. And what you've done is you've just given yourself a thing you want to achieve. You're no longer in denial, right? So, if you've got no goal you're aiming for with the money, not having that thing that you're saving money on is denial. But if you're actually not having it to achieve the savings target, it's a positive. And I think of it like smoking. No one ever gives up smoking that wants to be a smoker. They carry on smoking. The people that give up smoking are people that want to become non-smokers. They want to be healthy. The smoking is taking them away from the goal that they really want. And that's how you achieve things. And the same with savings. If you're like denial, I mustn't do this, I mustn't do this, I mustn't do this, it won't happen. It'll all feel really painful. But at the beginning of the month, you go, $200 is going away, and I know it's coming from these items that I spend too much money on normally. All of a sudden, down the month, you're like, no, I'm going to have to take money out of my savings at the end of the month if I do that. I'm not doing it because it takes you away from your goal.
Yeah. I guess reframing it as an investment, that savings goal, and budgeting as opposed to a sacrifice, I think can help be much easier. And that's, people love investing, people hate sacrificing.
Yeah, exactly. And it's not sustainable. You can maybe do it once or twice, right? Sacrifices aren't something you can do every single month. It has to be for something you want to achieve.
It seems like the psychology seems to be like a recurring theme in getting to happy ever after. I'd love to hear any other books or kind of like other inspirations that you think are kind of other core fundamentals that to read along with happy ever after that you think are kind of along similar themes.
Well, the most important one is Your Money or Your Life. The author of which I forget the name, but he was the guy that basically developed all the maths behind the FIRE movement. But I'm actually, do you know what? I'm going to be really self-serving and say there isn't one. I honestly wouldn't have woken up
Swiss
at 6.
Army knife.
Yeah, I wouldn't have woken up at 6 o'clock in the morning to write a book for my daughter if I could have bought one. It's in terms of just like really starting out with something that can explain things to a 17, 18-year-old. So you've got someone who maybe someone who's really good at maths, thinks they know all this already. It's the wrong book for them. But for those people who are just like, I don't even want to think about this, I had to take that attitude. It's like, I had to write for someone who is my daughter. She's at the age where it's like, because she's going to roll her eyes every time I say anything that she doesn't want to hear, right? So it's a tough audience, not an easy audience. So with that approach, I looked around. I I work, number one, I work in the industry. I know most of the books that would be in the right space. But I did look around, so talking to my teens, and it's like, oh my God, she's got, they're either too young or they're too old or they're too difficult or they don't do the whole thing. Or they get into too many specifics. I didn't want to teach my kids about 401ks because she's not American. And, I wanted it to have that sort of universal appeal. And you can't teach kids about how to do tax structures right because tax structures change every year. There's no keeping up with this stuff. You're going to have, once you got the money and it's going to go in, then you learn the tax structure, but not until. Right, so I would say your money or your life because it's the bedrock of the financial independence, retire early movement. I still love the guy, Mr. Money Mustache, his website. I think, I don't think he's done a book even, but that he just starts with the right approach and he says it, in a really, I love this. There's like one of his blog posts is, how to give up your stupid big car habit. It just, he says it right. It's so many things we do is stupid. When we don't think about them. It's just say it as it is, right? They are stupid.
Just don't sugarcoat it. Yeah.
Yeah, it's stupid. Yeah.
Fantastic. I have a couple of nephews that I'm taking early advantage of my Christmas list buying for nephews and nieces. So
excellent.
Perfect. Yeah.
I'm not saying it's all about the sales, but yeah, good. I like to hear it.
It's spreading the gospel. Spreading the gospel.
Exactly.
That's right.
Exactly. So so I have another book. If you go to the website, the $7millionaire.com, somewhere on there you'll find I have a thing called the $1,000 journal, and just to sort of make the point, that's mine. I self-published it, and the reason I self-published it is because I give it away. I would give this one away if I could, because it is about spreading the gospel. But it's, I did it through a publisher because they can hit all the markets everywhere in the world without me having to worry about making sure that there's deliveries and all that kind of stuff. For me, the big problem is actually solved by the $1,000 journal. The big problem in the world for financial literacy is not people that buy books or have people buy books for them. The big problem in the world is people who don't have books, who don't get books bought for them. That's like, of let's say $1 billion market that can really benefit from financial literacy. Yeah, probably somewhere in the region of 900 million of them aren't getting bought books. Hey, if I can sell 100 million books, I'm happy. Don't get me wrong. But that is the bigger problem, and that's why I keep that self-published, and I just give that journal away whenever I can because it's simpler and it's more basic. And so go on there and have a look at that one as well, and download that, and you'll see that's about the mission. But this one is more complex and is better for someone that one was really. We feel comfortable giving that to migrant workers. It's with low education levels, whereas Happy Ever After, you sort of, someone who's finishing school, it's just about right.
Beautiful. What a great graduation gift for folks. That's perfect. Michael, I'm curious, and I might already know the answer, but I'd love to hear it from you. When somebody is putting together their budget, I know you said that they should kind of work backwards from their goal, from their target, and then kind of pay themselves first, as you put it, and then whatever's left over, that's what they can spend. Is there a good goal that people should be targeting in terms of savings, whether as a percentage of the income or as a dollar amount? Should they save till it hurts? If it's too easy, is that not enough? How should people be thinking about that?
Well, you know the answer in there, right? Because that's all about psychology. But because if you do it too hard for you, really too hard, you're going to give up after 2 months.
You're not going to do it.
Yeah. So you've got to start easy and build up on it and build those muscles, right? I think so. Starting easy is good. I think the second thing is there's one of my favorite tips in the book is one that I was given and totally ignored when I was young, which is every time you get a pay raise, save half immediately. So like, let's say you're saving 5%, you get a 10% raise, you get another 5%, and put that because you're not used to the money. Right, so just put away half.
You're not going to feel it,
yeah. So it's easy. It's easy to put away, which is a great way of actually adding to your savings rate. The thing I would say, for most of us though, I'd actually in the book we discuss what is the percent you need to save to actually target a FIRE outcome. So let's say you need to, assuming 7% returns, right? So if you want to retire by the age of late 30s, early 40s. You have to be saving half or more than half of your income to be able to say like 55% of your income saved. You can retire before you're 40. If you think that that's just way too much and you want to say, okay, I want to get done by 50, you've got to work for 30 years and then have enough money left for the rest of your life. Yeah, you need to be saving around the sort of the 40% of your income. So the stats are all in the book with all the kind of different percentage rates. But that's one of the ways to think. You've got to pay for the rest of your life. And if you want to kind of have that as a target, where can I achieve that? I think one of the big inspirations I saw when looking at the FIRE movement is there's a couple, they're teachers in Las Vegas. And I'm not sure if they're in Las Vegas anymore. Their names are Joe and Ali Olson. I had a really great email exchange a couple of years back with Joe. And they retired after working as teachers for 8 years. That's all the time they needed to, right? It's just and he said, if they often get asked to go into the weeds about all the stuff they did, but essentially there was just one rule. And when they left college, they decided they would never spend any more money than they spent when they were in college. Because they just asked themselves, did we have a bad time when we were in college? No. So why would we need to spend 3 times, 4 times that when we're out of college? We'll just do what we did when we're in college and we'll have a great time. So they were basically saving 3 years of spending every year. They saved 75% of their income. That means you could, now if the maths there is super easy, right? There's almost no compounding involved, right? You're saving 3 years every year. In 8 years, you saved 24 years of your spending. You're out, you're done. And so if you want to really be aggressive, if I was 18, I'd be thinking, that's got to be doable, right? That has to be doable. That's such a great, and if you start thinking, okay, if I double my spending now to 50% of my income, I could be done before 40. And it's when I heard people talk about retiring by 40, I just had in my head that they're going to be like curing cancer or inventing the computer or this kind of thing, right? They had to be like crazy rich. And you just realize, no, it's about what you spend. If you're used to low spending, this can be done, right? And the beauty of that is like you can only do 2 things with money. You can save it or you can spend it. The less you spend, the less you need to spend when you stop working. So you're financially independent much faster. But you're also saving more towards it every month. So you're getting towards that goal faster. So it gets hit from both sides. You get to that goal much faster. That would be, you're asking me, back to your question, you're asking me what I would say. Yeah, if you're asking me what I would say to someone young, that's how I would ask them to think about it. How long do you want to work for? And wait till you've done your job for 2-3 months and then answer that question again. Right? Wait till you wait till you start feeling
life
the pain.
Beats you up a little bit.
Yeah. Wait till you start feeling the pain. I was like, I have to do this every day. I'm thinking 8 years is starting to sound really good, right?
Right.
It just that to me is how I would get them to think about it.
That is so good. That is so good. So I'm curious. One final question for you, and then I'll kick it over to Tom, and then we'll let you get out of here. But curious to know how you would think about real estate as part of this whole retiring early asset class and amount you need to retire. So I know that there's the 4% rule, or 25 times your spending you should have in savings to walk away from the job. So if real estate pays you, call it $200 a month, $2,400 a year, should that asset be valued at 25x as in a cash equivalent? Yeah,
it's a good question. It's okay. So it's about whether you're in a high yield or a low yield real estate environment. Number one, if you live in the property, it's not included.
It's right. I'm talking pure investment property. Yeah.
So if you live in it, it's not included. That's something that a lot of people get wrong. It's why it's really, really hard to do this in a low yield, high property cost city, for example, because so much of your asset is the thing you're living in and you're excluding it. So that's number one. Number two, I would we actually include it in the book, and it's called the 3-house investment plan. Because essentially, if you've got 3 properties and they're all roughly the same, you live in one, you take rent off 2. If you go back to the traditional rule that you should be spending 1/3 of your income on your accommodation, then 1/3 of your assets can be in accommodation. You live in one, you take the income off 2, you're probably good no matter where you are. So that kind of the simplest kind of retirement plan on the planet. And the beauty of it is, of course, with property, you get the income coming in and the capital gain is the capital gain. Just takes care of itself. So you're kind of matched with asset growth as well. So it's a super simple, nice plan. In terms of the other stuff, it's if you're in a low yield environment, then you kind of you should be looking at 4% as the rule, because you just won't be making enough return on those assets, right? So it's like you're going to have to really, really build up those assets. And you should probably be, if you're in a low yield environment and you're looking to retire on it, you should probably not be in real estate too much, right? Your money should be making money. So I live in Singapore. The place I rent makes like a 1.1% yield. Yeah, and I rent because I'm like, I can beat 1.1% with other investments. If I can't, I shouldn't be doing this, right?
Yeah.
I look around the region. It's one of the things I talk to when we're doing work with migrant workers. Places in the Philippines make like a double-digit yield. And, people that I work with, would tell me, don't tell them they can achieve financial freedom. It's like, they can make 12% yield on property. They can achieve financial freedom faster than I can. It's about doing that assessment. And I know in the US, I know very little about real estate in the US, but I know that the market's quite segregated. That there is a low yield part, like in uptown in big cities, and then there is like a high yield environment as well. And if you can capture that gain, just treat that as your investment base. I like the idea of simple property that you can just live off the yield you get and then let the capital base take care of itself. Because in many ways, that's what with the 25 times does, right? You spend 4% and you hope you make 7% in your returns, and that takes care of inflation. Whereas actually in property investing, your yield is your yield, and hopefully the capital gain takes care of the inflation. So it can be much simpler. I think I got really convoluted there because it is a more complex problem. But there is a simple approach to real estate of just take the yield and let the capital gain work on its own.
And also the whole very cheap debt, especially taking advantage of conventional financing, loan pay down. There's so many good details. So Michael, do you have any other questions? I got a quick rundown. I'll go through if you're done.
No, I'm all finished. Over to you, Tom.
All right, so this will be quick, Michael. So we have with some guests we bring this out. There's 10. It's kind of an either or type of question. You don't have to overthink it, and it's. I think you'll get the flow of it as soon as we get going. So are you ready for some quick fire questions?
Yeah, I've had coffee. We're good.
Okay, perfect. All right, consolidation or diversification?
Diversification.
High property taxes or high income taxes? It's a unique thing about the United States where some places don't have income taxes. You're welcome to punt on some of them and say neither.
Yeah, I'm passing that one. I'll tell you why. It's actually I don't get into political. That's a political debate, and I don't get into politics because the playing field is a playing field. Countries are clubs. Everyone gets to vote. Right. And I try and be international about what I do. So I have kind of no opinion. Other people set the playing field, we play in it. So I don't have an opinion.
I like that. High rent growth or low vacancy?
Yeah, not enough of an expert. Don't have an opinion. Sorry.
Got it. Cash flow, like yield or appreciation?
Cash flow.
Love it. Debt or equity?
Equity.
Single family or multifamily?
Oh, that's like talking about a property type?
Sure.
Yeah. That's because you guys are experts in that. I'm guessing.
Yeah, we're split. We're split too. Yeah. I think amongst us are all over the place. So,
I think as a non-expert, I'd be going single family.
Local or remote?
For most people, I'd say local. However, I'm going to have to cop a plea on that one and say that the property I own is miles away. But because
you're on the remote real estate.
You're on the right show.
All right, you're almost done. Turnkey or massive project?
Oh man, I've done.
And this is your opinion. So
I've done projects. So I'll take turnkey from now on, please.
All right. Final 3 questions. Non-finance or real estate related. Midnight oil or early bird worm?
Okay, I'm going to give a long answer. Because I actually have a real opinion on this one. So there's a reason I wrote the book first thing in the morning. I didn't know this until when I wrote this book. I write early in the morning. And the reason I write early in the morning is because I have an internal critic that wakes up about 10 o'clock. So if I start writing at 6, I can write 4 hours before someone in my head tells me it's rubbish, which gives me so much time to actually kind of get stuff done that otherwise I'd be like, double, triple, quadruple thinking it. And I can just get like 2,000 words done first thing. So early morning. And then if I want to edit it, later in the day, but not midnight oil ever. There's just like that. I'm chilled by like 8 o'clock. I'm not going to get anything done.
Yeah, going back to earlier conversation, it's kind of like paying yourself first in savings. It's like you're paying the beginning of your day to yourself, to something that you care about and passionate about.
Nice. Full circle, Tom.
Yeah,
full circle there.
Yeah, very good. We should go
right,
now.
Final
cut. Yeah.
All right, that's a great.
That's
final,
a wrap.
Final that's a wrap. That's a wrap. Final two. Almost there. Okay. Text message or email?
Text.
The last question, most important question: olive oil or butter?
Oh man, they both have their place. They both have their place. Why are we choosing between northern Italy and southern Italy? Let's take both.
Yeah. Fair. We need them both. All right, you made it through. Those are the quick fire questions. Michael, this was super fun. Thank you so much for coming on.
It's my pleasure. Great, yeah, it's really good. Thanks, guys. And look, thanks for doing this. I'm guessing that a lot of the shows you do are very similar to this, and you explore a lot of ideas. That's what we need, right? The most important thing is that people learn finance, and you guys are doing that so well as well. So whether it's in a little one area like real estate or broad, it just needs to happen. So thanks for doing it.
And just to confirm, the best place to find your book, you would recommend Amazon?
Yeah, I could go to Amazon. I think that's the best place to go. So Happy Ever After by the $7 Millionaire on Amazon.com. And I would suggest that as a starting place if you know that you've got, like yourself, you've got a niece or a nephew wandering in he may be a little bit young for the book. She may be a little bit young. But it's if you've got that niece or nephew, just go straight to the book. Because it really is everything in one place, and it's designed to be a little bit more fun and easy to get through than the website. But if that's not the reason, $7millionaire.com would also be the place to find me.